The main goal of every successful trader is to make forecasts and gain profits in the financial markets. It may sound like a challenging task, but still it can be done. Technical and fundamental analysis help traders to this. What are the differences between these two types of analysis? Technical analysis is the method of studying prices charts, which is used to predict future price movements based on patterns of traders' behavior in the past. Fundamental analysis is the method of forecasting market trends but analyzing news flow and macroeconomics reports. So which analysis method to choose? There's no right or wrong answer, as each analysis solves its own task. Practice proves that using both forecasting methods gives the best result in trading. While we regularly notify you about fundamental signals in the TV Forex news section, we would recommend that you get in touch with the technical aspects of trading. Our series of educational videos on the basics of technical analysis will help you get started. Again, technical analysis is the study of a chart's past movement in order to predict its future movement. In general, what is a chart in the financial market? We know that it demonstrates price changes. However, when it comes to candlesticks, novice traders will unlikely understand them at first sight. No, it has nothing to do with being romantic. It happened that candlesticks provide the best visual representation of price changes. Let's make the chart bigger, much bigger. And here we see rectangles. This rectangle is called a candlestick. Looking at these rectangles, we can tell how the price has changed over a certain period. Brief digression. The same trading instrument can be studied on charts of different so-called timeframes. A timeframe is a selected period for evaluating price movement. It can be 1 hour, 1 minute, or 1 day, but more often traders use 4 hours when making technical analysis. So, in this rectangle, we can see the price change for the selected time frame. For example, for 4 hours. Candlesticks have a body in the form of a rectangle painted in one of two colors and shadows in the form of lines above and below the rectangle. The green or default white color of the candlestick means that for 4 hours, the price was rising. By the end of these 4 hours, the price was above the level where it was 4 hours ago. A red or default black candlestick, on the contrary, points to a decline in price. That is, after 4 hours, the price was below the level where it was 4 hours ago. Notably, the start and end levels of these 4 hours often do not coincide with the high and low prices. During the selected 4 hours, the price may go beyond the opening and closing levels. These highs and lows form a candlestick's shadow. Sometimes it's also called a candlestick's wick. For forecasting the further movement of quotes, you should analyze a whole array of such candlesticks.